Welcome to the Snowbirds Expat Radio podcast, powered by the Snowbird US Day Tracker app. I'm your host, Jerry Scott, and my goal is to give you answers to your cross-border questions, to ease the stress of a cross-border move or extended trip, and to keep you up to date on all you need to know with cross-border rules and regulations. Now let's get on with the show. Welcome to the US Expat Radio podcast. I'm your host, Jerry Scott. We help Canadians moving south and Americans moving north. And today we have a guest, Robin Veenendaal. I probably butchered it again, and I do apologize, Robin. But what we're dealing with is dual filing. So when an American moves to Canada, Robin is going to go through all those filing requirements. Now, before I start getting into these questions, Robin, welcome to the Snowbirds Expat Radio podcast. Tell us a little bit more about yourself and your firm. And you're located in St. Catharines.
Yes, thank you for having me. I have been with the same firm since 2007. We are in St. Catharines, Ontario, and we have a little bit of a U.S. practice for individuals. So we are a border city, so we do have a lot of commuters, as well as just U.S. citizens living in Canada. And we do, although we're in the Niagara region, we do have clients all over Canada and some in the US as well.
Okay. So are you seeing with the current administration, and I try not to make this political, but do you find that there's a lot of Canadians coming home that are dual citizens, green card holders?
We have had some move. The biggest change I think we've seen is a lot of the snowbirds not going down there and trying to sell their condos down in particularly Florida. And also anyone who owns a rental property, a condo down there, they're finding it difficult to rent out right now.
Yeah, we're seeing the same thing in Maui. We're seeing a lot of Canadians are starting to sell their homes, or at least try to sell the homes because of all the problems in Maui. Anyhow, let's get right into these questions here because I know you're very, very busy and we appreciate your time. So let's start with the basics. When a U.S. person or green card holder moves to Canada, what are the key tax filing obligations they steadily need to be aware of both sides of the border?
So starting with the U.S. side, when somebody moves from the U.S. to Canada, it really depends on their status in the U.S. If they are a U.S. citizen, they're actually required to file their worldwide income regardless of where they live, just based on their citizenship. So their U.S. tax filing sometimes doesn't look too different from what they were filing as U.S. residents, unless there's a state, depending on where they're moving from. Not all states have personal income tax, but a lot do, and they might have to file a part year in that year. And then when they move to Canada, they might have new requirements for the U.S., depending on what type of assets they own once they move here. So if they open up bank accounts that are foreign to the U.S., so Canadian bank accounts, investments, corporations, anything like that could potentially open up some new filing requirements in the U.S. On the other hand, if somebody is a green card holder, not a U.S. citizen, a green card holder or long-term resident, in that year that they move, it's called the year of expatriation, and there is a form that's required, a statement of expatriation statement, and it could be subject to exit tax. So you have to be aware of what your net worth is at that date. If it is over $2 million, you may have an exit tax to pay, and some additional filing there. But it is something in that year, even though you are not a U.S. citizen, in that final year of filing in the U.S., you do have some additional reporting required. You also file a U.S. federal tax return for that year from January 1st up to the date that you moved and you changed residency. And that is called a dual status tax return, in that you file worldwide income from January 1st to the date that you moved. And then from the date you move to the end of the year, you're only reporting in the U.S. if you had U.S. sourced income, so income from the U.S. Some people keep their jobs there and commute or work online, so they might still have a U.S. filing requirement there. And then on the Canadian side, regardless of whether you're a U.S. citizen or a green card holder, you're now a U.S. or you're now, sorry, a Canadian resident, but you do have to file a Canadian tax return from the date you enter Canada to the end of the year, and that is based on worldwide income for that year. And then ongoing after that, just to be aware, once now that you're in Canada, depending on what kind of assets you own, you could have some additional information filing and foreign reporting on the Canadian side.
Now, quick question. You say $2 million. Would that be $2 million per person if we're including the husband and wife? So $4 million as a couple?
Yes.
Okay.
US. Yep.
Now, do you find that some of the people that come to you, do they enter Canada? Maybe it's a Canadian coming home, but what are the common mistakes that they would make when they move back home from the United States?
Yeah, so people coming back to Canada, we find some people are coming back after a number of years and some people are coming for the first time. Someone coming back, sometimes they went down there, they were down there for a large number of years, all their working years, and then they decide to retire and they come back to Canada. So a common question we get asked, and hopefully they ask before they action on it, but some people feel that they need to move everything with them to the US, or sorry, to Canada. So they're leaving the US, they've retired, and they have a big IRA, 401k, like a retirement savings, a plan down there, and they want to cash everything in and bring it to Canada. And that is something that you shouldn't do for tax purposes, because that does make it taxable in the US all in that year that you draw it out. But that is a big, I would say, misconception that that a lot of people have, that you have to cash in those investments when you move up to Canada. A common oversight, I would say, is the failure of those individuals to notify the people that hold investments, bank accounts, pensions for them. So if they have those assets in the US, it's important to notify those holders of those assets that they are moving to Canada, because if you're not a US citizen or a green card holder, you can have them withhold the applicable treaty rate of tax after you move on pension income, dividend income, and then you don't have any more filing requirements in the US. We see it a lot where people move up and they never notify these people, and the tax reporting continues longer than it has to because of that. The person holding the investment account doesn't know that they're no longer a US resident.
Now, before I get into the Roth IRA question, do you find that when people do leave, they believe that it's okay that they can maintain their relationship with their current investment advisor? It's going to be a 30 plus year relationship. How often does that come up on your end, where all of a sudden these clients are panicking, saying they got a note from their dealer saying you got to move these assets, either cash them in or move them to someone who can manage it? Is that common?
Yeah, very common. So I would say a lot of advisors in the US, especially investment houses that don't have affiliate offices in Canada, they don't want to hold, and maybe they're not licensed to hold the investments for a non-US resident. There's definitely additional reporting and filing required. So they do often advise, as soon as somebody calls the investment advisor says, I'm no longer a US resident, I'm moving to Canada, the investment advisor oftentimes says, oh, then I can't hold your account anymore. And that's where these people get this idea that I'll just cash it all in and move to Canada. When that's really, I mean, maybe that particular advisor can't hold those funds, but they can, within an IRA or a 401k, they can still transfer those assets to another holder that can, or another financial institution that can hold those assets.
And you're aware of one. We won't mention on air here. Now, the other question I have is that we're also finding out how much trouble does a person get in if they leave all their non-registered assets in the United States and use their mother's or their father's or their dog's or their cat's address. Okay, how hard is that for you when you're filing tax returns if you're not getting those tax receipts?
Yeah, and I mean, a lot of people do that. As soon as their advisor says, if you have a Canadian address, we can't help you anymore, they immediately say, oh, here, use this address. Some people just use a PO box. And then the reporting is still US based. And it does create, like I said, it's a bit of a problem when we go to do the tax return and it's months and months, sometimes years later, they're still getting slips and tax withholding as if they are a US resident when they're not. It's a bit of a complication when we file the tax return because we know how the tax return needs to be reported, but it doesn't necessarily follow how the slips
Now,
are
we know how
issued.
severe the IRS is when it comes to issuing penalties. Is Canada the same way? If they know that these people are not declaring this income, then all of a sudden 4 or 5 years later, they're declaring it? Are there penalties? And will they ever get audited? Have you heard anything?
Yeah, I mean, Canada does have penalties on unreported income. Now, if it's something that you genuinely didn't know that you had to file that income and report worldwide income in Canada, we do have a voluntary disclosure program that could help, where you come forth voluntarily and say, I didn't know I was supposed to either report income or even disclose assets on a foreign income verification statement, which is Form T1135. And that's required if you're living in Canada and you have, say, a non-registered account in the US over 100,000 Canadian, you are required to disclose that to the Canada Revenue Agency. And if you didn't know you were supposed to do it, we can file under voluntary disclosures so that we say, I'm coming forward voluntarily. I didn't know. Here's the information, and you request that no penalties apply. That's also a one-time thing. You can't just file under voluntary disclosure every couple of years and say I didn't know. So there is relief, but yes, there are penalties for not reporting that income or disclosing those assets when
Now, one thing we're
applicable.
seeing on our side, on the wealth management side, need to care about how we say that, is we're seeing a lot of these American Canadians coming home or Americans moving up here. They have their Roth IRAs and they forget to file the election. Tell me a little bit more about the election, the timing around it, and what happens once again if these people weren't aware of it. What are the how can we fix those problems?
Yeah, so a Roth IRA, for anyone that doesn't know, is similar to our tax-free savings accounts here in Canada in that the earnings are generally not taxed in the US, and when you contribute to it, you don't get any sort of deduction. There's slight differences in that they're really meant specifically for retirement in the US. So there is criteria to make it tax-free in the US. The length of time you have the account open, the age that you start withdrawing from it, etc. And when you move to Canada with that Roth IRA, you can continue to have that Roth IRA and it can actually be tax-free in Canada. However, you need to file an election with Canada Revenue Agency. And when you file this election, you're basically deferring the tax that's on the income earned within the account. So as you have a capital in the account and it's earning dividends, capital gains, interest, whatever, as that income is accruing in the account, it's not being taxed in the US, and it would be taxable in Canada if you don't file this election. So when you do move to Canada with a Roth IRA, it's important to file that election for that reason. The other provision for this account is under the treaty. This account is recognized as pension income to the extent that it's a pension in the US. So in the US, if you follow all the rules and had you been a US resident when you draw from that Roth IRA, if it would have been tax-free in the US, it will be tax-free in Canada as well. So between the treaty and the election, you can really move this Roth IRA up and have it continue to be a completely tax-free account. One major stipulation is that you cannot contribute to the Roth IRA after you move to Canada. So you cannot have any Canadian contributions to the account. If that happens, your account is really split into two, and the balance in the account from prior to those contributions forms one pool, and it continues to be tax-free, assuming the election is filed. The other half, the contributions, the income on those contributions, they're completely taxable here in Canada. So to file the election is actually quite easy. It is a letter. It's a one-time election. There's no form to fill out. You just write the letter in whatever form you want. They just have certain criteria information that they need. So off the top of my head, the name of the financial institution that's holding the account numbers. If you have more than one, you do have to disclose all the Roth IRA accounts, the balance in the account at the date that you became a Canadian resident, and also a statement that you're not making any contributions and you understand you are not to make any contributions as Canadian resident. And that just goes, it's paper filed, it's mailed to a specific department at the Canada Revenue Agency, and it's one time and it's not revocable. So you just file it once when you move here, and you're set. And that election has been filed. I should note, it's due on the due date of your tax return for the year you move. So if you move to Canada in 2025, your Canadian tax return is generally due April 30th of 2026. That's the date that election would be due. Administratively, we've seen the CRA accept late filed elections for these accounts. There's actually they have an email address, which is not something you see all the time with the Canada Revenue Agency, but they have an email address for that specific department that you can email to arrange the late filing of those forms.
Robin, the other thing that we're seeing is that, people are becoming very educated out there when it comes to cross-border matters. A Canadian living down in the States, but we're being contacted 5 years in advance. And they're asking us, do we know much about the backdoor Roth strategy? Have you heard much about it?
A backdoor Roth strategy?
Have you heard that saying before?
I'm not familiar with that term, meaning they can open up a Roth IRA before they leave the U.S., like they purposely do that? Is that what that's referring to?
It's very common. This is the biggest difference between a TFSA in Canada and a Roth IRA United States is that when you're cashing in monies from your IRA and you're doing this strategically based on your tax rate, and the problem is that a lot of these folks are having these $1 million IRAs. Well, they're able to take out a certain amount in tax and pay the percentage in tax and roll it into their Roth IRAs. And then when they, the strategy, because we were on a show, there's a fellow in the States, wrote a book called The IRA Millionaire. His name is Craig Weir, and we were on his podcast. And we couldn't believe that more and more Canadians aren't using this strategy. If they're coming home and they know they're coming home, they can start taking all that money out of their IRA, pay their 30% tax, put it into their Roth. Yes, there is limits on when they can pull it out. And then when they come up to Canada, they've got their entire retirement savings in that Roth up here in Canada. And the biggest thing is that it's just allowing these people to pay a 30% tax rate. And we know the tax rates in Canada are a lot higher if they're just having that IRA and pulling money out of it. So I'll have to send you the link to this advisor. In fact, he doesn't sell it as a tool to manage all the assets. He charges a flat fee. He does all the tax comparisons, and then he moves forward from there. So I guess on that point is leads me to my next question. How important is it to you to be able to communicate with those advisors in Canada that are duly licensed, so you can put together a nice little team for them? And maybe all we're missing is that immigration more before they move on.
Yeah, I mean, if it's when someone moves here with a Roth IRA, the important thing is that we just need to be aware of it. So the advisors and the taxpayer need to be aware of the filing that's required, because like I said, filing the election is actually very simple, and it can save you a lot of tax, especially in a case where you have $1 million in a Roth IRA. That's huge that you can bring that up to Canada and maintain its tax-free status on both sides. And I'd hate for somebody to miss out on that because they just didn't know they had to file an election with the CRA. So being aware of the filing requirements, obtaining all the information, grabbing, those account statements at that date, so that you have the information ready for the election, and filing it on time. You don't have to wait to the due date of your tax return. You could file it earlier if you want, just to make sure that you have it filed in good time, and confirmation from the Canada Revenue Agency that the election is applicable.
Now,
And the other thing to just a thought, is it doesn't just apply to somebody moving to Canada with a Roth IRA. It would also apply to somebody inheriting a Roth IRA.
yes, and that kind of leads me to the next one, is the inherited IRA. And we're seeing a lot of, maybe mom and dad lived in the States for years and years and years. They've since passed. And now we're seeing a lot of inherited IRAs by these Canadian kids that are now in their 50s, 60s. How common is that in your practice when you're coming across inherited IRAs?
Oh yeah, we definitely see it a lot. Inherited IRAs, there's new rules that came out, I want to say in 2020, for somebody who passed since 2020. In that, if somebody inherits an IRA, now there's different rules depending on who it is that you're inheriting it from. If you're inheriting it from your spouse, you have a lot more options. It basically can just become your own IRA. If you're a designated beneficiary of an IRA and you are a minor child of the deceased, if you are chronically ill, disabled, or if you're no more than 10 years younger than them. So that we don't see a lot, but if you inherited an IRA from a sibling or a friend, then you have a few more options than what we see most, which is adult children inheriting them from their parents, which is the example that you used. And what happens in that case is they can withdraw the entire IRA in one sum if they want. Again, that's not ideal from a tax perspective, but they do have 10-year up to December 31st of the 10th year after the person passed away to draw out the IRA, and they have to take draws from it. Now, if they're not a U.S. citizen themselves and they're a Canadian resident, what they want to do is they want to make sure that whoever's holding that IRA knows that they are not a U.S. citizen. They want to know that they're Canadian resident, and they can claim the treaty rate. So the holder of the IRA can give them periodic draws once every year for 10 years until the account is depleted. They're going to hold the treaty rate of tax back, and that satisfies the U.S. tax filing obligation. There's no need to file in the U.S. if that's the case. And then in Canada, you're, of course, taxed on worldwide income, and you can claim a foreign tax credit for that tax that you paid in the U.S. on that IRA withdrawal. So for people that do inherit these IRAs in these situations, ideally, you want to spread that draw over those 10 years, or if you know that your income is lower in one year than another, to maximize the low rate tax in those years. And you just want to take those periodic withdrawals and make sure that the proper reporting is done for those.
It's working both sides of the border and seeing that this, the beneficiaries can receive this inherited IRA. It's too bad we didn't have something comparable when we inherit our parents' RIPs, which are fully taxable at the estate level, and then whatever's left gets distributed to the beneficiaries. Okay, here's something else that's been really big over the last couple of years is we were talking about Social Security and we're talking about Canada Pension. I think it's called the windfall elimination provision that kind of changed that landscape. Do you want to go into a little bit more about that?
This, we see this a lot with people that work, like I said, maybe they live in Canada, they moved to the US for their working years, and then they move back to Canada in retirement. So now they've paid into potentially Canada Pension Plan, they've paid into the US Social Security system, and they might be eligible for US Social Security benefits and Canada Pension benefits, or maybe they don't have enough credits on the US side. So if they have enough, U.S. Social Security is based on credits, which is basically working years that you've worked in the U.S. and paid into that Social Security program. And in Canada, of course, we have our CPP or QPP if you're in Quebec. based on based on the working credits, also based on what you've paid into the program. We also have OAS, or old age security. That is not based on credits or working years. It is based on your age and your residency. So you have to have been resident in Canada for 10 years after you turned 18, or 20 if you're actually collecting and not, when you're retired and collecting, you're not living in Canada anymore. You have to have lived here for 20 years after you turned 18. So if you worked on both sides and you're coming up to that retirement age, and you on your own qualify in both countries, if you have the required credits in the US and you have made contributions to the Canada Pension Plan, you can apply in both countries and get your benefits in both countries. If you go to apply in the US and you don't have enough credits on your US work experience, they can actually take credits from your Canadian CPP working years and help you apply for partial benefits in the US based on those credits. In Canada, it's a little different. The CPP retirement portion of those benefits, as long as you've made one contribution to that plan, you're eligible for CPP, and they don't have to take into account your US working credits. However, if you are eligible, Canada Pension has a little bit different in that they have their retirement benefit, they have their survivor benefit, they have a disability benefit. For the survivor and disability benefit, they can take credits from the US working years if applicable. And what's easy about all of this for anybody that this applies to is you can actually just apply at one office in whatever country that you're in, and you can apply. Say if you're applying in the US for US Social Security, on the application, it actually asks if you are also wanting to apply to Canada. And what they do is it's like a combined application, and each country assesses your ability and eligibility based on their own laws. If you're eligible, it's all processed. If one of them needs credits from the other, they will automatically take it as appropriate.
And we covered a lot of content this afternoon, which has been very, very helpful for everybody, I'm sure. But without mentioning names, can you share some of those really head scratchers situation where someone came to you and they had themselves in trouble because they moved up to Canada or moved down south? Share some of those horror stories with us.
Yeah. So one example that comes to mind, just talking back about changing that residency and having that date established. When you move up from Canada and you notify people that you moved, you want to make sure that date is consistent with how you're going to file. I did have a situation not that long ago where somebody notified Service Canada a little bit too early. And so Service Canada updated their Canada Pension and Old Age Security that they were Canadian residents as of, I don't remember the exact date, but say February 1st. And at the end of the year, they got an NR for, they were already collecting CPP and OAS as US residents. And so for the month of January, they got an NR for a non-resident tax slip from the Service Canada. And then they got a T4 slip for February to December. But in actuality, they didn't move to Canada until, I want to say, July or August. So under the Canada-US tax treaty, Social Security benefits, so US Social Security, Canada Pension, Old Age Security, those are only taxable in the country that you reside in. So in a part year, the portion from January to whenever they moved was only taxable in the US. But the Service Canada had issued T4 slips from February to the end of the year. And you can't not report income that's issued on a T4 slip because Canada Revenue Agency will match it up. And it was very difficult to get that corrected and to get those slips reissued. So one common sort of mistake that we have seen is the failure to recognize that date of residency and being consistent with it by informing payers of pension, bank accounts, financial institutions, and things like that. Another thought you mentioned about going the other way. We've been mostly talking about people coming from Canada, coming from the US up to Canada. Another thing I've seen too many times is somebody moving from Canada to the US, again, not quite establishing that date on an exact time. They're a little bit weary to give up that Canadian residency, especially for provincial healthcare reasons and things like that. And they move to the US, and then they continue to receive benefits, child tax benefits, GST credits, things like that. And they continue to contribute to their tax-free savings account. And 2 years down the line, they say, actually, I'm really not a resident of Canada anymore. And they go back and they change their residency status with the Canada Revenue Agency. And automatically they get nailed with repayment of any benefits they received that they weren't entitled to, as well as hefty tax-free savings account penalties on having that account and contributing to it while they were non-resident. So I think just no matter which way you're moving, you have to have that date of residency change and know what you're allowed to do and what you're not allowed to do and what you're entitled to from that date
I
forward.
wonder, as I'm listening to you, I wonder how many of these problems are created by that loving, trusted advisor on the U.S. side only, and then maybe there's a loving, trusted advisor on the Canadian side, but they just don't have the knowledge. And, these clients depend so heavily on these advisors, believing that they have all the answers. But I know what we're experiencing is that the advisors have done most of the damage. Maybe these clients are moving up and they're buying Canadian mutual funds as an American person or someone who's still required to file U.S. Canadian returns. Like I say, these are trusted, loving advisors, but there's not enough. There are some good cross-border advisors in Canada that we are aware of, but I just find that a lot of the problems are coming from advisors not knowing, not deliberately giving them wrong advice, but being put on the spot. Do you see that as well?
Oh, absolutely. Absolutely. And not necessarily intentionally, but just having no knowledge of what is applicable. And I mean, mutual funds, you brought it up. It's a great example. There's a lot of advisors that are maybe only licensed to sell mutual funds, and mutual funds have a place in people's investment portfolio, but for a U.S. citizen, they can be very problematic, and it's possible that the advisor just doesn't know of those additional reporting requirements.
So if you could give one piece of advice to Americans moving to Canada, what would it be?
I mean, be aware of your filing obligations on both sides of the border for tax filing, as well as any sort of information returns, and what assets, once you move, what assets are going to create additional reporting and disclosures. And then we just mentioned it, use professionals that have the appropriate knowledge. It's fine if you had an investment advisor in the US for 30 years, but when moving to Canada, you might want to cut ties with that particular advisor and move to somebody that just has that knowledge that's going to help save you tax, help for tax planning, and just maximize your investments on both sides.
I think what you're saying is have a plan before you land.
Exactly.
So,
Yep.
Robin, thank you very much. This has been incredibly insightful, very knowledgeable. I know one of our colleagues, Carson Hamill, speaks very highly of you, and he invited you to be one of our guests on the show. He said you got to have Robin. She is very down to earth, and if you're from St. Catharines, I'm sure we're all rooting for the same baseball team tonight. I believe we
Yes.
are out here in the West. We are also Jays fans. So thank you very much for your time. Now, how do people get a hold of you? I know we're going to put together a great package for you that you can put onto your website. We're going to put it on our social media sites. But other than that, what's the easiest and quickest way to get a hold of you?
Yeah, so I do have, email is the best probably. We are on my website, or on our firm's website. I am listed there with my contact information, or you can, distribute it with your package there. It is, my email address is my last name, my first and last name. So I would recommend going to the website and not relying on the phonetic spelling.
Okay, I know
of it.
I butchered your name, and part-time Maori resident, it's in my vocabulary to butcher every Hawaiian name. So a little bit harder to pronounce the Hawaiian names. But I truly appreciate your time. And once again, people can also reach out to us at Snowbird US Day Tracker. They can also reach out to Carson Hamill, and we're always looking to pass referrals on to the great partners that we have, which is including Robin here. So thank you for your time. Go Blue Jays, and let's hope we get a win today. Thank you again for listening to the Snowbird Expat Radio podcast. The best way you can support the podcast is to forward the episode to a friend, and please don't hesitate to like, subscribe, or leave a comment. Now, before you go, let me leave you with one of my favorite quotes. Be kind to all, the world is small.